Hello, friends. Today's topic is about understanding financial statements, and what does this chapter cover about? Okay, so first of all, it covers about balance sheets, and then statement of profit and loss, and then cash flows, which consist of operating cash flow, investing cash flow, and financial cash flows. Okay, now before we go into deep into these, I mean the concepts and everything. So I'd like to just show you what the balance sheet actually looks like. This is a snippet from the book itself. Okay, you see, this is the balance sheet where what is explained is, I mean, the asset side, uh, asset sides, whatever we have is equal to the equities and liabilities side. So from the equities and liabilities, we buy assets, and they both should match with each other. Okay, and then if you go to the profit and loss statement, which is like from these what is the profit and what is the expenses we have made for in the complete 1 year period or whatever 3 months period we define. So that's being noted in the profit and loss statement. And the third part is the cash flow statement, which talks about, so in the profits that we have generated or in the assets that we have created, how much has been my actual cash flow, whether the profits I have made has turned into a cash inflow into the company or not. So that is what is depicted by the cash flow statement. Now that covers the summary of this slides or the so and then we'll go into deep into these of the each of I mean each of the concepts behind these behind creating these documents. Okay, so first of all, what is there probably are the main business activities? If we see that, so first of all, we establish at an organization level, we establish some goals and strategies, and then we raise finances, and then we invest in resources, and then we conduct operations. So this is what the whole business activities or business cycle is, and these conducting operations results in financial transactions or financial inflows or outflows, and that's what is captured in the financial statements. Okay, so there are some basic concepts while creating these financial accounting or financial statements. So that's what is listed here. So I'll cover each of these in this section. So first of all, equity concept, which says that owners and suppliers, creditors are considered as parties transacting with the entity. An entity or the business is considered a separate entity. Okay, so business is no. Suppose a person X creates a business, so that business is treated as a separate entity apart from the person. Then money measurement concept is says that every heterogeneous, all the heterogeneous concept components of the business are like the plant, equipments, inventories are all treated in the common denominator. Okay, which is the money. So everything is converted into the money so that we have a common denominator and a homogeneous way to assess the financial state of the company. Then what comes is a stable monetary unit concept, which says that although the inflation goes up and down, and probably it always goes up, so we don't consider the purchasing power of the money while accounting. Then the next concept is going concern concept, which says that entity when created, it is considered that it will stay or it will stay alive throughout the lifetime. It's not going to close in few years. Then cost concept, then it talks about that all the transactions are generally recorded at their cost value and not at their current market price. So basically it is applied to assets. Okay, so assets are recorded at their cost. Then conservative concept, it says that uh, basically it modifies the cost concept. So we don't anticipate profits, but we provide for or we make provisions for all the losses, possible losses that can happen. Okay, so that's a conservative way of treating the financial aspect of the company. Then the dual aspect concept talks about the assets is equal to liabilities plus equity. So you get equities from your shareholders and you I mean you create liabilities by taking debt, and those things actually goes to your assets. I mean that's get converted into assets. Okay, so moving on, what we have is like accounting period concept. So basically the whole year or the whole transaction period is divided into sub chunks like 1 year, 3 months, 6 months, and then the accounting is done in for those period. Accrual concept. Okay. So accrual concept, it talks about I mean whatever the revenues we are generating, and I mean when they are made or the services are rendered or the products are delivered, that time we consider that the a transaction is made, regardless of the cash, regardless of the fact that when the cash is being actually being received by the company. And then there's a concept called realization concept. So the when the goods are shipped to the customer, that time we realize the transaction, not when we have purchased that or contract is signed or the we have got the sales order. Okay, so probably we have got a sales order first, but when that goods is shipped and or delivered, that time it is considered as the transaction is realized. Now, matching concept says that uh, for for revenue that we are generating, we consider or we match the expenses of that product. Okay, we don't mix like the whole revenue and then whole expense of the company. We don't try to match that. For a particular product, what is the expenses being created or being incurred? So that's the matching is done. Okay. Now, so how to record the actions? For that, what I have done is I have taken the reference from the book itself and I've created the Excel file. So I'll switch to Excel file.
So this Excel has been divided into two parts, like the transaction description, and then what happens is on the assets liquidity liability side. So that's being shown here. So first thing that happens is, so Mr. Ram, who contributes 5 lakh rupees for as an equity capital, and in the name of Ram Enterprises. That's the name of the company being opened up by Mr. Ram, and the money is deposited in a a bank account. So what happens is, this is the transactions. This is the way the transaction is recorded. So bank deposit, it goes up by 5 lakh, which was zero initially, and share capital also goes to 5 lakh. The second transaction, now pay attention as that it's now called as Ram Enterprises. Okay, so Ram Enterprises is now considered a separate entity, and Mr. Ram is not is you know is not same as Ram Enterprises. Now he pays the enterprise pays 1 lakh as deposit for hiring office premises. So the office premises gets added here as one of the row item, and this full 5 lakh becomes 4 lakhs. The third transaction is talking about that the furniture and fixtures are bought. So furniture and fixtures being bought of 3 lakh rupees are being added here, and bank deposit also reduces by 3 lakhs. It goes from 4 lakhs to 3 lakhs, and the furnitures and fixtures gets added. So these are all assets which the enterprise is adding for itself. So transaction 4, what happens is, uh, so Mr. Ram actually buys an, or Ram Enterprises buys an merchandise, or basically some kind of material for doing the business of 3 lakh rupees on credit. So what happens is merchandise is getting increased to, or it's getting set to 3 lakh rupees here, and since it is bought on credit, so that is something that that's an liability actually, so that's why it gets recorded as a trade credit of 3 lakh rupees. So the 5 lakh rupees balance has sheet has balance of asset has become 8 lakhs now. Okay, now what happens is, so this merchandise or this raw materials or any kind of material which has been bought, it's been 1 lakh rupees of that material has been sold for 1,20,000 for on cash. So the reserves and surplus. Okay, first what happens is the merchandise actually reduces by 1 lakh rupees. From it 3 lakhs it becomes 2 lakhs, and then the bank, since it is sold on cash, so bank deposit immediately increases from 1 lakh to 1 lakh 20 by to 2 lakh 22,000. There is an addition of 1 lakh 20,000, and this 20,000, which is the surplus here, it gets added as reserves and surplus. Okay, so reserves surplus of 20 lakh 20,000. So it total becomes 8 lakh 20,000 up till now. Transaction 6 happens is that the same merchandise of 80,000 is being sold on 1 lakh on credit. So still we do not have that money. So the merchandise reduces by 80,000, and the debtors actually that increases by 1 lakh here. Okay, and then 5,000 establishment expenses being paid out. So from the reserves and surplus, 5,000 gets debited, and the bank deposit also correspondingly it gets debited, right? So from the money is paid by the bank from the bank deposits, and thus your surplus and reserves also gets debited by 5,000. In the next transaction is 9,000 cash rent is paid in cash. So again, this is debited from the bank account, or then the reserves and surplus also reduces by 20 by 9,000 rupees. And the last transaction, what happens is another depreciation of the furniture happens. So here the furniture gets depreciated by 10,000 rupees, and thus the reserves and surpluses also goes down by 10,000 rupees. So it becomes 16,000. So at the end of the all these transactions, the balance sheet goes to 8 lakh 16,000 rupees here. Okay. So I hope you understood up to this point. So how the various transactions are recorded. Now, probably there are so many other ways to record this transaction, but I think, there are different kind of transactions arising from from various business operations. We don't need to probably, most probably we don't need to go into the depth of how these transactions are recorded, but this is just to give a fair idea that how the transactions are recorded in general. So the understanding of this concept of this of a particular transaction, how it's being recorded on an asset side, on a liquidity, on the liabilities and equity side, it's important. That's just concept, and some few examples are important. Okay, moving on.
Having understood how the transactions are recorded, and then basis of these transactions the balance sheets is actually created. So let us see some balance sheets which we have seen earlier also a bit at the start of the session. So if you see, this is what the the balance sheet is consisting of. It consists of at the equity and liability sides, it consists of shareholder funds, then the long term borrowings, deferred tax, and then current liabilities. And on the other side of the balance sheet is assets, which has non-current assets and current assets. Okay, so we'll talk about these individually, what these constituents are. Okay, okay. So okay, so the items in the balance sheet. Okay, so first of all, equities. Equity represents the firm, what the firm owes others. So any owner of the company has a shareholders equity or shareholders fund, current liabilities, non-current liabilities. Now, characteristics of the shareholder funds are listed here. So basically it is risky. It is no fixed rate. There's only dividend which you can expect from the shareholders equity, and then there is a concept of preference capital where the dividend rate is payable on it is generally fixed. Okay, so that's what the preference capital is. So a dividend here is pre-decided that they will get so much. It's kind of an interest, but there is no, I would say, a legal. I mean, it's not a must. Only if you have a gain, then only you are going to give dividends. Okay, and then reserves and surplus is something that whatever the retained earnings you have, you what happens is we operate the business, we get money generated from the business, and those cash is actually gets converted into the reserves and surplus. So now whether do we give it as a dividend or we keep a part of it so that we can invest that in the next year, and then grow the business or create more assets, create more ways to generate business. So that is what reserves and surplus is. And then against the share warrants, whatever money we receive, that is the shareholders. That's called a shareholders fund. Now there are some non-current liabilities also. So if you see, non-current liabilities are like uh, these are the liabilities which are to be paid after more than which have a tenure of more than 1 year. So it consists of say long-term borrowing or term loans from financial institutions and banks in India and abroad, rupee bonds and foreign currency bonds, and then public deposits. But often these are unsecured borrowings, and these are secured borrowings. Okay, typically secured by, so any financial institution, if it is giving a loan to a company, it will also try to secure that it has a security against the assets that the company has. But as compared to that, if you and me as a public go and give a loan to the company, it's generally unsecured. Okay, then there are deferred tax liabilities. So because the tax differences that we have, probably the taxable income and the accounting profit, so there are some tax temporary differences which are being created over a period of time, that are termed as deferred tax liabilities. Then long-term provisions are something like provident fund, gratuity, superannuation. So these are things like leave encashments and other provisions. So these are considered as long-term provisions, non-current liabilities. And then other non-current liabilities are like towards the premium of redemption of non-convertible debentures, uh, and different kind of non-current liabilities are being considered into this. Then current liabilities, what it talks about is liabilities which are to be settled within the 12 months after the reporting date. And what does it include? It includes, say, short-term borrowings, which has a tenure of less than 1 year, then working capital loans, intercorporate deposits, commercial paper, public deposits maturing in less than 1 year. Then trade payables, so amount owed to suppliers who have gold and goods and services on credit. Okay, so this is another important thing, because trade payables is something that we owe to the suppliers, because they have supplied us goods and services on credit. And similar way, we would have also got um, we would have also sold goods and services on credit. Okay. Then short-term provisions, like mainly represent provisions of dividend and taxes. And then other current liabilities, like current maturities of long-term borrowing. So if you have taken a long-term borrowing of more than 1 year, and that uh, part of that maturity actually falls in the current 1 year period, then these are considered as current liabilities. And advance payment from the customers also is considered as a current liabilities, because we are expecting that whatever advances we have received, we will have to pay it back to the customers within a certain period. So that's what is also considered as a current liability. uh, Now, on the what are assets actually? So what we have seen is the liabilities and equity side of the balance sheet, and then this topic is about what are assets on the below side of that balance sheet that we have seen. So what are assets? Assets are something which um, are which are going to provide some benefit into the firm in terms of economic way. So whether it will have a higher cash inflows or lower cash outflows or whatever. So any assets, any plant machinery which is going to be used by the business for creating a cash inflow or outflow. And resources are recognized assets in accounting when the firm acquires rights over them as a result of the past transactions, and the firm can quantify future economic benefits with a fair degree of accuracy. Okay, and then you have again segregated into non-current assets and current assets. So what does a non-current assets consist of? So it's like long-lived assets, fixed assets like land, plant, machinery, and they are reported in the balance sheet as their net book value. So the gross value, the cost of acquiring the assets, less the accumulated depreciation. Okay, so this is how this is calculated. Then there are some intangible fixed assets also, like patents, copyrights, trademarks, and goodwill. And they are the difference here is that instead of depreciation, they are I mean the amortization of these assets is being considered. So that's the difference between a tangible and a fixed intangible fixed assets. Then capital work in progress, intangible assets under development. Okay, this is what is non-current assets are. Then there are non-current investments also that we have made. So equity shares, preference shares, and debentures of other companies. And it's mostly associated with the standalone, oh sorry, associated companies and subsidiary companies. And this is held for a long period of time over the, I mean, for the purpose of an income and control. Suppose the Tata Group actually has a very good stake in Tata Motors, TCS, and various subsidiaries it has like Titan. So, so the parent company has a non-current investment, basically a long-term investment in these companies in their subsidiary companies. Okay. Then there are deferred tax assets, long-term loans and advances, and other non-current assets. Okay. Okay, so and what are current assets or intended for sale in the normal operating cycle, say of 12 months or so, and this is basically held for the purpose of trading, and it's something that it's like a cash or a cash equivalent. Okay, and it's basically which is going to be settled within 12 months. That's the uh, motive of these kind of assets. So it could be like short-term investments in mutual funds or in shares of other companies, and basically these are considered at the cost or market value. Okay, or whichever is lower, it's being considered for. And then inventories also are current assets. So raw materials, work in progress, finished goods which have not left your premises yet, and you still own them. So packing materials, stores, and everything also is considered as inventories and current assets. And now, how do we value the inventories? It's like cost of the inventories is equal to purchase cost plus conversion cost or plus other cost incurred to bring them into the current location and condition. Okay, so that is how the inventories are calculated. And then what you have is the raw material stores and the packing materials, and then it's generally determined on weighted average basis. So basically, uh, average on an average, how do you maintain it per month or month by month basis? So at the on the basis of that, we calculate the raw materials and these kind of the cost of these items. The work in progress and finished goods, there is a difference that now these for these items you have already processed them, and you have done some processing and some inputs also you have given to these kind of assets. So what happens is there is I mean, allocation of manufacturing overheads also gets embedded into the work cost of these kind of current assets, which are like work in progress and finished goods. Okay, I hope this point is clear. So raw materials and everything, packing materials, these are traded items, and it's they are on the weighted average. They are being calculated the cost of these assets, and work in progress and finished goods. Since we have applied some kind of manufacturing overheads, so these are also considered to be considered along with the basic cost of the material. There's one more current asset which is like trade receivable, also called as accounts receivable or sundry debtors, which is like amount owed to the firm by its customers, okay, who have bought goods and services from the on credit. So if you have sold some product on credit, the amounts that you are going to receive in the short period of time, that is called as a trade receivable, or in other terms, or in other way, it's also called accounts receivable or sundry debtors. Also, what we do is the debts we classify into two types or two three types, like debts which are exceeding than 6 months and other debts. And also there is one more thing like good debts and uh, debts considered as doubtful. So in India also, I mean, RBI is considering, or has been considering, of creating a bad bank. Now bad bank is supposed to do what? It is supposed to take away all the bad debts of all the banks altogether, and then it wants to create a separate bad bank which has all the debts, and then somehow try to monetize that. So this will help the banks to you know um, uh, lessen their burden for recoveries, for understanding what or tracking those NPAs. So that's one thing that RBI and Government of India has been trying to do. Okay, so welcome back, and this section will talk about profit and loss statements. So what is a profit and loss statement? So it's basically whatever or whatever summary of the operating and financial transactions which have contributed to the change in the owner's equity during the accounting period. Basically, how the transactions has helped to owner's equity has changed. So that's what this profit and loss statement is going to talk about. So basically, what is the formula is like profit after tax is equal to revenues minus expenses. Fine. And then there's a two principles that we have talked about previously. One is the realization principle, which realize the revenue when the transaction generating the revenue takes place, not when the cash is received. And the matching principles says that when the item is sold, that time we consider it as a transaction being recorded. Okay, so let us see the profit and loss statement of from the book itself. Okay. So yeah. Hmm. Okay, so it's been compared for 2 years. Like the revenue from operations is about 1290 crores, and then other income has been 10, which probably is an interest income or could be any other income. And total revenues is then addition of these two, which is 1300 crores. Now from that the expenses are calculated. So expenses are material expenses, employee benefit expenses, and then finance cost, depreciation, and other expenses. And then profit before exceptional basis is called PB. Before, okay, let's call it like before the any exceptional and tax. So PBIT is called. it's about 180. Okay, so total, so what is happening is 1300 minus 1220 is coming out to be 180, and there has been no exceptional items here, so stays 180 here. And then profit before tax is also 180. Now tax expense is about 50 crores, then the actual profit is about 130 crores. So basically the company has done a revenue of 1300 crores, and but the actual profit that it has earned is about 130 crores, and from there the dividend has been paid from this profit. Okay, so what you see is that what has professor has been telling is that debt, it's a taxable instrument, and the tax benefit can be achieved. So basically, suppose if you have paid more tax, you get a you get to show that your profit is also low, and then you have to pay less dividend as compared to if you have taken all the things and equity. So that is a tax shield that we get when we have done a tax benefit, which we'll cover in the later part of the chapter when we cover the chapter 10, 10 to 16, I believe. Okay. Now I'll just move on, and then okay. Mm. So I hope you understood up to this point. So next part of the chapter is talking about cash flow statements, which is actually the towards the end of this chapter. Now, what are cash flow statements? Okay, so basically, balance sheet and the profit and loss doesn't focus on the cash flows. Although a company probably is generating a lot of profit, but it might be that it is not able to generate cash. So so unless the cash flow statement is seen, we cannot make out whether the cash has been generated by the actual cash has been generated by the company or not. We'll also see it with in an example, a live example of a company. But let us understand the concept first. So what it says that there are three type of cash flows, okay, which we have talked at the beginning of the chapter. One is operating cash flow, okay. Then there is an investing cash flow from the investment activities, and there is a financing activities cash flow, okay, cash flows. So simple, inflows minus outflows is equal to the cash flow from operations, investing activities, and financing activities, and we add all this, then what becomes is net cash flow of the period. Okay, so that is what we get as a net cash flow. Now if you see this cash flow, it's like um, so what we have got is like the profit before the tax, so 180 crores is what we got, right? And then there is an adjustment for depreciation, financing cost, and so basically this is operating activities, right? So we do the adjustments, like these are the additions which gets added. Okay, so that becomes 250, and then from there you have a trade receivable, inventories, trade payables, that what we need to pay to our suppliers, and then direct tax paid also is also added. So net cash flow from the operating activities is about 180 crores. Now from the investment activities, what happens is you have purchased a fixed asset, which is an investments you have made in the company, and then non-current investments and reduction in long-term loans and advances, interest income, then becomes 90 as a negative 90 has become the investing activities cash flow. Similarly, financing activities are like long-term borrowings that you have made, short-term borrowing that we have made, dividends which are being paid out, finance costs being paid out, that comes out with 30. And so net cash flow from financial activity is about 80 crores. So net cash generated is about 10 crores, A plus B plus C. And then cash at the beginning of the period was about 70 crores. And then this is also coming from one of the statements actually. And then at the end, when we add these two, so at the end of this financial year, the total cash that the company has about 80 crores. That is how it's a cash positive company as of today. So this is what this cash flow statement is talking about. Okay, now what will happen is I'll just move to uh, an example of this company, say, to understand just a more practical and current aspect of this company called Titan. So we all know it's a Titan company which is owned by Tata Group, and it has mainly business in diamond and jewelry. Okay, so we'll go to its balance sheets first of all. So what we see here is over the years, the share capital has remained more or less same. Okay, then total reserves of the company has basically, reserves is something which has company has generated as a profit or as a cash inflow. So that has also doubled, almost doubled over the years from 2016 to 20. Then borrowings have remained null, and then other non-current liabilities basically have remained, have gone down. So we can see that the first thing is that this figure and this figure are matching up. Okay, and so that we need to understand. And then if you see the current liabilities has increased actually, so which is like this will come back to it, but you see the current liabilities have increased for the company over the period of time. Okay, so is their assets. So if you see, their assets have increased and current assets have also increased, because as we can make out from this balance sheet. Okay, if we go to the profit and loss statement of this company, what happens is um, the net profit that they calculated is about 1517 crores. Okay, so net sales is this, then the total expenditures is this, operating profit is coming out to be a minus of these two figures, and then other incomes they have added, interest income they have probably deducted, interest expense actually. Okay, so then depreciations they would have deducted, and then coming out to be, it's like this is what their net profit is. So although this company, right, Titan is showing there is a net profit in their in their profit and loss statement. Now let's see the, it's an interesting part, the cash flow of the statement. Okay, so the same thing what we saw here is 21 profit before tax. Okay, so 2104, it matches with this figure. Okay, and now if you see what happens is then there's an adjustment being made, and then so working capital changes, like it has increased. So basically they are not able to, probably they need to borrow for to meet their working capital needs, and then the tax paid is also reducing, actual tax paid. And then if you see, the operating cash flow has decreased. Okay, so basically their operations in the March 2020 it has decreased. Okay, it was increasing from um, 566 crores to 1248, it had doubled, but then it has decreased in the last year. Then the investing cash flow has increased, and the financing cash flow has also decreased. Okay, so overall this company has been a negative cash flow company. But previous to that also, if you see, the company probably heavily invested last year in 2019, and that is why its cash flow was again negative in this year. And then if you see here itself, the company's cash flow was low in this 2018 also. So here also it was negative. Only in 2017 it has been a positive cash flow company. Okay, here the operation cash has increased a lot, and that's why uh, it was a cash positive company. Now, if you see what also is can be inferred is the investing cash flow. So they probably made a good investment this year, and then they reduced it in 2018. In 19, they again made a similar kind of investment. In 20, they didn't make any investments actually. Okay, so we can make out that the company invested heavily in 2017 and 2019, for which the benefit is going to come in future. Okay, so although profits were shown, but actually it is a negative cash flow company, and this is also being shown, taken and mentioned here. The company has negative cash flow from operations. Okay, uh, and so that is what they have mentioned here also, no notified as a bad factor for this company. Okay, so this brings us to the end of this chapter 1, which I have tried to summarize in this short video. I hope you liked it, and any queries and suggestions you have, how to improve upon this video series, just let me know in the comment box. I'll wait for your feedback. Thank you. Bye bye.